Gold has a very specific moment when it looks smartest. It's usually when the world feels unstable, when headlines are loud, when uncertainty feels permanent, and when other assets suddenly look fragile. That's the moment people start talking about gold with a certain tone, almost like relief, as if they've finally found the sensible move, the adult move, the move that protects them from everything else going wrong. I've been there. I know that feeling. It feels calm, rational, almost obvious. When stocks feel risky, currencies feel questionable, and the future feels foggy, gold looks like clarity. It looks like history. It looks like discipline. And that's exactly why it so often disappoints. Not because gold is useless, not because it's a scam, not because it doesn't have a role, but because most people come to it for the wrong reason, at the wrong time, with the wrong expectations. Gold tends to look smartest right before it stops doing what people bought it for. When I first started paying attention to gold, I didn't see it as a trade. I saw it as a solution. Something that sat outside the system. Something that couldn't be messed with by policy, printing, or bad decisions. It felt like opting out of chaos. That framing is seductive. It makes you feel like you're stepping above the noise instead of participating in it. But what I didn't understand yet was that gold doesn't sit outside human behavior. It sits right in the middle of it. Gold is not just a metal, it's a psychological asset. Its value spikes when fear spikes. Its appeal grows when confidence shrinks. And its most convincing moments usually happen late in the cycle, not early. That's the part nobody wants to admit. Gold feels smartest when the reasons for owning it are already obvious to everyone else, and markets don't reward obviousness for long. Most people don't wake up randomly and decide to buy gold in a vacuum. They arrive there after something else has already gone wrong. Inflation surprises them. Markets scare them. Trust in institutions erodes. And suddenly, gold feels like the answer they should have had earlier. So they act. The problem is that gold is a response asset. It reacts to conditions. And when those conditions are already fully priced into fear, the upside that felt inevitable often turns out to be limited. That's not a flaw of gold. That's a flaw of timing. Gold does its best work quietly, when nobody is excited about it, when it's boring, when it's not trending, when it's not being used as a headline hedge. That's when it's actually cheap insurance. By the time it becomes a conversation piece, the insurance premium is already high. One of the biggest mistakes people make with gold is confusing protection with progress. Gold can protect purchasing power in certain environments, but it does not compound productivity. It doesn't innovate. It doesn't generate cash flow. It doesn't adapt. It just sits there. That's not a criticism. That's the design. But when people buy gold, expecting it to behave like a growth asset, disappointment is almost guaranteed. Because gold's job is not to make you richer in expanding systems. Its job is to help you not lose ground when systems break. Those are very different goals. The trouble is that fear blurs that distinction. When people are anxious, they don't just want protection, they want reassurance. They want something that feels solid and correct. Gold gives them that feeling. The feeling is real. The results are often not. I've watched people buy gold during moments of peak anxiety and then hold it through long periods where everything else recovers. Stocks recover, businesses grow, new opportunities appear, and gold just exists, quietly. Year after year, people tell themselves they're being patient, when in reality, they're being stuck. They feel safe, but they're not moving. That's the disappointment. Not a crash, not a betrayal, Just opportunity cost slowly piling up while nothing happens. Gold rarely disappoints dramatically. It disappoints quietly, through underperformance, through stagnation, through the slow realization that the world moved on while you stayed defensive. Another reason gold looks smart right before it disappoints is because narratives peak before performance does. When gold is being discussed everywhere, when the logic sounds airtight, when every argument lines up neatly, that's usually when most of the move has already happened. Markets don't move on logic alone, they move on positioning. By the time everyone agrees gold makes sense, most of the buying pressure that made it attractive has already been spent. That doesn't mean gold can't go higher, it means the risk reward has shifted. And most people don't adjust their expectations when that happens. It means the risk reward has shifted. And most people don't adjust their expectations when that happens. They buy gold thinking they're early, when they're actually late to the reason they believe in. Another subtle trap is how gold changes behavior. When people buy gold out of fear, they often stop thinking creatively. They stop looking for growth. They stop considering productive risk. Gold becomes a mental endpoint instead of a component. They don't ask, what comes after this? They assume the answer is more of the same. But fear is not permanent. Crises pass, liquidity returns, systems adapt. And when confidence comes back, capital flows toward productivity, not protection. Gold doesn't fail in those moments. It simply becomes less relevant. And that transition catches people off guard. They bought gold to feel prepared for collapse. When collapse doesn't fully arrive, or when recovery begins instead, they don't know what to do next. Selling feels like admitting they were wrong. Holding feels safe, so they do nothing. That inertia is expensive. Gold also attracts a certain type of thinking that can be dangerous if left unchecked. It invites absolutism. People start talking about real money versus everything else. They frame the world as fragile and doomed. They anchor their identity to being cautious. There's comfort in that mindset. It makes inaction feel principled. But markets don't reward identity. They reward adaptability. The people who use gold well don't talk about it much. They don't obsess over it. They don't frame it as a worldview. They treat it as a tool that serves a specific function at a specific time. They buy it before it's popular. They hold it while it's necessary, and they reduce it when its role diminishes. That last step is the hardest, and it's where most people fail. Selling gold after it has validated your fear feels wrong emotionally. It feels like letting go of safety just as you proved it was needed. But that emotional attachment is exactly what turns protection into stagnation. Gold is meant to be held with detachment, not conviction. Another reason gold disappoints is that people underestimate how long nothing can last. Gold can go through multi-decade periods of flat, real returns. Not dramatic losses, just sideways movement that slowly erodes enthusiasm. During those periods, inflation still happens. Life still moves forward. Opportunities still appear. And the person holding gold feels increasingly behind, even if they technically didn't lose money. That gap between expectation and experience creates frustration. People expected clarity, they got waiting. People expected certainty, they got ambiguity. People expected safety to feel rewarding, it just felt static. That's when gold stops feeling smart and starts feeling heavy. It's also worth acknowledging that gold often attracts people at moments when trust is already broken. Trust in governments, trust in markets, trust in institutions. Gold feels like opting out of disappointment. But opting out of broken systems doesn't automatically opt you into better ones. Protection without participation is not a strategy, it's a pause. Pauses can be useful, they are not destinations. When gold becomes a destination, disappointment follows. I've noticed that the people who regret gold the most are not the ones who lost money on it. They're the ones who held it while other parts of the world grew around them. They look back and realize that safety came at the cost of scale. They didn't fail, they just stayed defensive for too long. Gold looks smartest when the future feels narrow, when imagination shrinks, when people stop believing in progress and start focusing on survival. Those moments are real. They matter. And gold can play a role there. But if you mistake a defensive moment for a permanent state of the world, you lock yourself into a posture that no longer fits when conditions change. That mismatch is where disappointment lives. The irony is that gold works best for people who don't need it emotionally. People who can hold it without hoping it saves them. People who see it as one piece of a larger system. Those people are usually early. They're usually quiet. And they're usually willing to let go. Most others arrive when gold feels obvious. When the logic feels undeniable. When owning it feels like intelligence. That's usually when the easy part is over. Gold doesn't fail investors because it's flawed. It disappoints because it's misunderstood. It's treated like a solution when it's really a response. It's treated like growth when it's really insurance. It's treated like an answer when it's really a tool. And tools only work when you know when to use them and when to put them down. If gold feels extremely smart right now, the most important question isn't whether it will go up or down. It's why it feels smart to you in this moment. What problem you're trying to solve, what fear you're responding to, and whether that fear is already priced in. Because gold doesn't reward belief, it rewards timing. And disappointment usually isn't sudden. It arrives quietly, in the gap between what gold was supposed to do for you and what it was ever designed to do in the first place.